The Federal Reserve is hiking rates again to fight inflation in the U.S. The Fed raised its benchmark interest rate by 0.75 of a percentage point Wednesday. It's a third consecutive hike of that size in the rate that is the basis of savings accounts and borrowing rates for consumers and businesses. It's the fifth increase this year. And Fed Chair Jerome Powell says the bank will keep at it, signaling more of the same by the end of 2022, possibly pushing rates to their highest level in 14 years.
Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 4.4% at the end of this year.
Jeanna Smialek joins me for more. She's a Federal Reserve and economy reporter for the New York Times. Jeanna, it's good to be with you again. When we talked last week, the consumer price index was higher than a lot of economists expected, meaning that inflation was more persistent. We knew the Fed was going to raise rates, but did you hear anything today that suggested that the Fed was also surprised in how persistent inflation has been?
Absolutely. I think that it's pretty clear from the way Chair Powell was talking about inflation and from the projections that the Fed put out that inflation has surprised them with its staying power. We've really seen consumers be capable of bearing rate increases and continuing their spending. That's partially, he said today, because they have so much saving on their balance sheet, which they amassed over the course of the pandemic, both thanks to government stimulus checks, but also just because people were stuck at home and had a lot of time to save money. And that is really helping, spending to continue, and it's helping inflation to stay much higher than the Fed had anticipated in light of the interest rate increases that it's already made.
I noticed, or I think this is right, tell me if it is, that the Fed was guessing in June that their ultimate target rate would be basically a point lower than the guess they're now making about their ultimate rate. Is that more proof that they kind of underestimated the power of inflation?
Absolutely. What we saw today was a real markup in the interest rate path that they are predicting for the economy, which is their way of saying to Wall Street investors, to America, really, that they plan to tamp down the economy much more than they previously did. They are thinking that they're going to need to push interest rates much higher in an effort to slow down consumer demand, in order to slow down business expansions and hiring. And the end goal here is really to bring that inflation to heel. And they just think that's going to be a harder job than they previously had expected.
And just briefly, to help me and our viewers out, what happens if the Fed is right? I mean, what kinds of activity do people stop doing, or as a result of these increases in rates?
Right. So essentially, I think you have to think of it as sort of short-term impacts and longer-term impacts. So in the near term, these interest rates are going to make all of the rates that we all pay in our everyday lives a little bit more expensive, or considerably more expensive, depending on the one. So we've already seen 30-year mortgage rates shoot up really substantially. They're basically at their highest level since 2008. We're seeing these rates filter into auto rates. So it's a little bit more expensive to buy a car now, not just because prices are increasing, but also because financing is increasing. And we're clearly seeing it showing up in business borrowing and business, sort of financing arrangements. And so those sort of filter out through the economy. They make it harder to spend money. That's the short-term effect. The longer-term effect is that this slows down the economy really drastically. And so the Fed itself is projecting that unemployment is going to rise at least a little bit to 4.4% next year, up from 3.7% now. And economists say that that's pretty optimistic. If we actually follow through on the kind of rate increases that we're projecting now, it could be substantially higher than that. So we could see some economic pain down the road from this.
Well, and that's exactly, you've taken me right to what I'm most interested in, which is employment increasing. I mean, if you and I have already discussed the fact that the Fed has been surprised by inflation, that they have to smash this button harder, might they be surprised about how painful the job losses might be and how much growth will contract, and therefore this so-called soft landing where unemployment isn't affected too much and growth isn't affected too much, that's kind of gone now, that it seems like the landing's going to be hard?
I think that's absolutely the case. So I think that what we heard from Chair Powell today is that the Fed is just hoping against hope that the very unusual economy that we're experiencing right now is going to help us not experience extremely high unemployment down the road. job openings are very elevated. So they're hoping that can come down. Supply chains have obviously been a mess. So they're hoping that those will heal. Neither of those things is a guarantee. It seems extremely possible that actually this will be quite painful in the job market. And if you talk to many economists, they'll say that that's probably a good bet, actually. And so the soft landing is becoming harder and harder to see as time goes on and as this inflation lasts.
So final question, Jeanna, is the inflation's now over 8%. The Fed's trying to get it down to 2%. Do we have any sense of if this works out as the Fed would hope, or even on a moderate timeline, kind of how long this would take to work out in the economy before it's down to 2% again?
By the Fed's own projections, they think that this is achievable by basically 2025. So definitely a couple of years. It's not going to go quickly, but they see a lot of the wind coming out of that inflation starting next year. And so they do see a relatively quick return to something that is less painful. Whether we get back to normal immediately is an open question. It's important to note, though, that those are very uncertain projections, and everybody has been very repeatedly wrong about how long this inflation is going to last. A year ago, we were still talking about the idea that it might be transitory and short-lived and not something the Fed even had to react to. And so I think it's important to take all of these projections with a grain of salt.
Absolutely. An important final point. Jeanna Smialek, thanks so much for being with us again. We appreciate it.
Thank you.